Hello, I'm Sean Richards and I write the Not a Yes Man's Economics blog. What I want to talk to you about today is one of the crucial changes, events of the credit crunch era, which is the behaviour of house prices, and particularly in the United States. If we go to the chart, kindly provided by Yahoo Finance, what we see there is quite a pickup in house prices in the period 2013, 2014, 2015. And in fact, for a while, house price growth in the US, as measured by CoreLogic, went above 10% a year. Dipped back a bit later, then picked up again in 2017, 2018 to more like 6%. This was in response, in my opinion, to the easier monetary policy we saw, lower interest rates, then quantitative easing bond buying, leading to mortgage rates falling quite a bit. However, this made a real change. What I mean by that is, if we look at wages and how they responded, well, they didn't. In essence, roughly, through the period we've just looked at, 2012 to 2018, wage growth was more like 2%. There's been a big shift, therefore, in terms of the fact that house prices became more unaffordable. How would I define that? Well, firstly, relative to wages. Secondly, another way of saying the same thing is that people had to take on higher levels of debt. How could they take on higher levels of debt? Well, because mortgage rates were lower, and therefore in terms of a monthly repayment, this was affordable. But this begs quite a few questions if we skip forwards to now. Yesterday's numbers from CoreLogic gave us a hint that house price growth is slowing, so of the order of, say, 4% now. Okay, so that's a change. As it happens, wage growth has picked up a bit. The latest numbers from the US are a bit over 3%. So the gap's narrowed, but there's still a gap. And the wrong way around, in my opinion, because house prices relatively are getting higher, if you look at it in, say, real terms relative to wages. Now, what will happen next? Because there's contrary strands here. The bad news from the house price perspective, and why they've slowed a bit, was a tightening of US monetary policy and also the slowing of the world economy, which fed into the US economy. If we stick with the US economy, current measures, remember these numbers are annualised, show possible economic growth of about 1.5% for the first half of the year. So as we put it in the UK, 0.7, 0.8%. That brings us to a position that's quite a bit slower than where we were before. If we go and now look at mortgage rates, roughly in 2018 they went from 4% to 4.9% if we look at the 30-year fixed. So that was one trend. However, when we came to December, a bit before the turn of the year, there was something of a shift, not only in terms of language from the US Federal Reserve, but then later in terms of policy. This has brought mortgage rates down quite a bit from that peak, 4.9%. They actually fell last week in terms of the 30-year mortgage rate to 4.06%. So we now have a reverse pull looking ahead on house prices in the US. So it's my opinion that we could see more of the same this year, of around about 4% growth. And again, that's both good and bad. It's good in the sense that house price growth is lower because, for example, how are first-time buyers ever going to buy a house if we just carry on like this? That is the road to ever lower interest rates that we've seen around Europe, maybe the UK. If we look at it from the perspective of millennials, then around about 74% of them, according to CoreLogic, are having to spend less in other areas to try and buy a house. Actually, those numbers changed yesterday probably slightly. For those of you that follow the stereotype about avocado toast and millennials, avocado prices went up 34% because of Donald Trump's rhetoric on Mexico. So, this is my point. House price growth, looks like there'll be some, but that's not as good as some will tell you, because how are first-time buyers ever going to buy a house if we carry on like this? Thank you.